We are wrapping up the trading day on December 18th, and we see that the market is up 1% exactly. The past 5 days, we're down about 1.5%. Year to date, the market, we're up 16.02%. Past year, not as high, but we're getting close to year to date being 1 year because it is December 18th. Past 5 years, if you invested in the market, you would be up 83%. So we looked at this chart last time, and we want to look at it again to really wrap our brains around the fact that the market is usually up more often than it is down. This is data from 1960 onward. So this is the past 65 years, and you can see a lot more blue than red. But the thing is, growth doesn't go on forever. We see pullbacks. Sometimes we see drastic pullbacks like the great financial crisis. Sometimes we see 3 consecutive years of pullbacks like the dot-com bust. So we've seen 3 healthy years in the market, 3 double-digit growing years in the market. We see many, many times where it's up 3%, or it's up 3 consecutive years and then it pulls back, up 3 consecutive years and then it pulls back. So what are we facing in 2026? Because the market has gone up so much in the past 3 years, we should expect a pullback sometime, maybe 2026, maybe 2027, maybe not until 2030. But as this chart shows, it's going to happen. We don't know when. So it is more important than ever, since we are at sky high valuations, sky high prices, sky high PE ratios and multiples, that we pick stocks very carefully. We want to make sure that we preserve our capital, that we build our wealth. And so in this video, we're going to look at 5 companies in the material sector. We're going to score them, evaluate them, compute intrinsic values as possible buys in our Inner Flame 2026 portfolio. Just a reminder that nothing that I say in this video is financial advice. I am not a financial planner. I'm not an expert. I'm just a casual trader and investor. So all I ask from you is to like and subscribe. If you get anything out of these videos, please subscribe to the channel. We're building it out, and we're trying to get as much information out there that we can about good, solid, healthy investing habits. This is aimed at new professionals, people new in the market, people that don't really know what they're doing. We're trying to get information out there in the basics on how to pick stocks, how to invest our money, how to not do anything stupid with our hard-earned capital. So in the material sector, what we see are 5 companies that come up on our stock screener. So in a recent video, we looked at how to use a stock screener to find value plays and to find good buys, quality companies in the stock market. So I will link that in the description of this video. So we have 5 companies that come up with those very strict, very specific criteria in our stock screener. We see NEM, which is Newmont. We see CDE. We have SSRM. We have CTVA, and we have NUE. These are 5 companies in the material sector. And what's interesting is that 3 out of 5 of them are gold miners. So NEM, Newmont Corp, is a gold miner. CDE is Coeur Mining. And SSRM is SSR Mining. All 3 gold companies, gold mining companies. If you've been following the gold market, you know that gold has gone up, silver has gone up, precious metals have gone up. And so what we're seeing in the numbers is that is expected to keep on going. The only 2 non-gold miners here are Corteva and Nucor, which is an agricultural input materials company and a steel company, respectively. And so what we're going to do is analyze these 5 companies using our scoring method. So if you're new to this channel, what we do is we look at growth metrics, we look at safety metrics, and we score each company based on those values, and we try to find good deals in the market. Okay, we try to find quality companies. These scores will range from -10 to +10. -10 means absolute garbage, worst company ever, don't even invest, don't even look at it. +10 means the best company in the world and a very, very good candidate for earning our hard-earned money. So of these 5 companies, all are above 0. 0 is kind of sort of average, so that's good news. All 5 are above 0, but we like to be a little bit more picky on this channel. We like values of 5 or higher, and only 3 fit the bill for materials. We have SSR Mining, we have CDE, and we have Newmont. So what we see in these numbers are fantastic PEG ratios, fantastic forward PEs. We see 5-year forward PEs, phenomenal. Now, the one thing that raises some issue here is that SSRM has expected 5-year annualized EPS growth of over 100%. I will note that we are not going to use anything close to that, nor are we going to use anything close to 75% when we do our projections and our intrinsic value calculations. These are very generous numbers. It's going to be very difficult for any company to pull that off 5 years in a row, let alone just 1 or 2 years. And so, yes, those numbers are quite high. Please understand, we are not using those in our intrinsic value calculations. Now, when we look at the safety scores, we see something quite similar. NEM and CDE are at the top, they're above 5. SSR mining is down below at 2.9. And what we see is that some companies, yes, they do offer dividends all around the 1% mark. They grow them not too fantastically, but Newmont, the steel company, has grown their dividends for 52 consecutive years, making them dividend aristocrats and dividend kings. So what we're going to do is, since the materials sector is a blend of growth and safety, it's a blend of dividend payers and non-dividend payers, what we're going to do is we're going to average the two scores together. We're going to average the growth scores, and we're going to average the safety scores. And that's what we've done here. So the growth score for NEM was 9.4. The safety score was 7.9. We averaged those together to get 8.65. And we do similar for the other companies. Now, again, we want to be selective in this process. And so what we're going to do is we're going to eliminate anything that doesn't have a score of 5 or higher with a quick catch here, okay? What we're going to do is we're going to erase CTVA and NUE, the steel company, okay? Reason being is that they have scores under 5. The one thing is we're going to keep SSR mining in here because their expected growth was so high. We're not going to use numbers over 100% for their EPS growth, but we do note that that's a company that has some solid potential in front of us, okay? So in the description, you will also find a way to find intrinsic values. So we went through a PE multiples ratio model, and we went through a dividend discount model. Because not all companies offer a dividend, we're not going to always use the dividend discount model, but we will when we can. And we will always use the PE multiples ratio, which basically projects your earnings per share out, scales it back over the course of 10 years using a discount rate. Excuse me. And if there's a dividend discount model and a PE multiple model, we are going to average those two. I also want to point out that the discount rate is between 12 and 15%. So these are higher risk plays because there's a lot of uncertainty baked into this market. There's a lot of uncertainty in mining. There's a lot of uncertainty in materials in general. And so we want to bake in more safety. Remember that the higher the discount rate, the lower the intrinsic value will be. So for all these companies, we use values between 12 and 15%. So if you want to see how we made these spreadsheets, I show you in tutorials in the description below. So you can check out the PE multiples model. You can check out the dividend discount model. Any sort of intrinsic value calculator is going to be your best friend. Why? Because Warren Buffett famously said that value is what you get, price is what you pay for. So just because the price of CDE is $17.16 doesn't really mean anything. What's truly meaningful is that CDE has a price of $17.16, but intrinsically it's worth about $31, okay? So based on expected growth, based on terminal rates and projecting this growth out into the future, discounting it back with a discount, what is it truly worth right now? And the PE multiples model says that, yes, CDE is trading for $17, but it's really worth 31. And so that's giving us a 45% margin of safety. So if you want to check out those spreadsheets, if you want to check out a step-by-step tutorial on how to do that, I will have the link to those videos in the description below. So what were the results of the intrinsic value calculations? Well, NEM has an intrinsic value of $228, and CDE had an intrinsic value of $67. Now, $67 came from an expected EPS growth of 45%, okay? Very, very generous. I think that was somewhere like in the 70s or 80s on our value sheet. So we're not going to be anywhere near that. We are giving it a very generous 45% for the next 5 years. Remember, the way that we built that spreadsheet is it's 45% for the first 5 years, and then we cut that EPS growth in half for years 6 through 10, just to be more cautious and to be more conservative. So $67 is the intrinsic value for CDE, and $102 also using a 45% growth rate. Remember, SSR Mining had expected growth of something like 138%. We're not using that, okay? That's giving us a 5-year forward PE of 0.3. That is just not possible, okay? If it is possible, this is the deal of the century, but it's not possible. So if we were to use 45%, we're still getting a very healthy margin of safety of 78%. Now, some would argue that 45% EPS growth for 5 years is not likely at all, and I would agree. And so what we're going to do instead, to be extra cautious and extra careful, is that for CDE, we will use a EPS growth of 30%, which means that knocks our intrinsic value down to 31. And if we use that same 30% growth for SSR Mining, that gives us intrinsic value of $48. Now, these are still phenomenal margins of safety, well above our 20% threshold. And so if I click and drag these down, as we like to do on our channel, we say, if we had $100 to invest and we had to invest in these 3 companies, what's the best way to do that? Okay, based on their average scores, based on their intrinsic value, we get a spread, an allocation of this $100. And I use 100 mainly because it's a nice way of converting that into percents. So if you want to think of it as percentage and you want it to get into the material sector, and again, this is not financial advice. Nothing that we say on this channel tells you to buy or sell anything. This is just for educational and entertainment purposes. But the way that we would do this at Interflame Financial Research is we would invest 48% into NEM, 29% into CDE, and 23% into SSRM. And again, those are just percentages based on values of $100 invested. So if you had something like $800 to invest, then you would invest accordingly. So like and subscribe if you got anything out of this video. We're going to keep building out our channel. We're going to try to get a solid base of support and new investors. This is really aimed at people that are new to the market, that they're trying to figure out what to do, where to allocate their capital. Maybe you're a brand new professional, you're getting a regular paycheck, you have a salary, and you want to get into the investment game. That is really what this is aimed at, is how do you find the best companies? How do you find the best stocks and the best places to allocate your capital? We are using very conservative, very cautious numbers here. We are using very strict criteria and stock screeners to find those best companies. So again, like and subscribe. I appreciate you being here, and we'll see you on the next video.